Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
We say everything happens for a reason because random chaos doesn't fit on a greeting card. Maturity is realizing you were wrong. Wisdom is realizing you'll be wrong again next week. Most life lessons arrive late, uninvited, and with no return policy. The economy is strong, fragile, resilient, and slowing, all depending on who's presenting the slide. We say long-term because saying we have no idea sounds unprofessional.
This screen says it all. Software is not correcting, it's being re-rated. The market isn't scared of weaker demand, it's scared of irrelevance. We have moved from AI helps your product to AI is the product. If your SaaS merely disguises a workflow, agentic AI now does the workflow itself, faster, cheaper, and without a subscription tier. That's why the entire sector is bleeding together. The moat question has flipped from who has the data to who cannot be replaced. This isn't FOMO anymore, it's FOBO, fear of becoming obsolete. This chart is not about confidence, it's about survival spending. Big tech is not investing because returns are clear, they're investing because not spending risks falling behind. When 4 companies plan to outspend their last 3 years combined, that's not normal capex discipline, that's an arms race. The bet is simple, build scale now, figure out monetization later. And pray utilization catches up before investors ask very awkward questions. AI may be transformational, but history says every revolutionary technology starts by torching capital. Oil prices do not move because of opinions, they move because of steel and geography. This chart is a real oil market. VLCCs slash cost on long haul routes, Aframaxes jack up sensitivity on short ones, and canal-friendly ships decide which arbitrage even exists. When checkpoints like the Suez Canal or the Panama Canal sneeze, freight doesn't adjust politely. It reprices crude prices globally. Futures talk all day, but tankers quietly cast the deciding vote. In oil, logistics is not a detail, it's the market. Gold's rally is not being driven by weddings or central banks anymore. It's being powered by momentum. In 2025, jewellery demand is down nearly 20%. Central bank buying is down 21%, and yet prices are surging because speculative and investment demand has exploded to 44% of total demand. That's ETFs, bars, coins, fast money, and not patient reserves. The last 2 times this share crossed 40% in 2011 and 2020. Both memorable for volatility, not stability. Gold isn't wrong here, but it's being held by shorter hands. This table says global equities are not stretched, they're historically crowded. India looks pricey, yes, but zoom out and MSCI, ASC, WIs is floating with top of history valuations on both price to earnings as well as price to book. Even emerging markets, usually the value pitch, are trading well above their long-term comfort zone. The only thing still cheap, the equity risk premium, and thus doing all the heavy lifting. In plain English, markets are not pricing growth anymore, they're pricing faith. A big fall from the peak does not automatically make SMIDs cheap. It just means that they fell from very expensive to less very expensive. This chart shows the real issue. Valuations are normalizing from a once-in-a-decade extreme and not from fair value. Even after the correction, median SMID multiples are still well above the long-term averages. That's not capitulation, that's digestion. History says real SMID bargains only appear when panic meets earnings pressure and not when optimism quietly recalibrates. Price fell, valuation hasn't surrendered yet.